let's jump straight into it. Welcome to today's Explainer, where we're doing a fast-paced overview of the last 24 hours to get your trading day properly set up. We're going to break down the critical macro drivers and, of course, the actionable technical levels you absolutely need on your screens right now. Look at this quote for a second. It perfectly captures this tentative, almost uneasy diplomatic pause we're seeing in the Middle East right now. After all that intense escalation, back-channel talks are definitely gathering pace. But listen, make no mistake, this calm is highly conditional. The flashpoints are still very much active, which means supply risks are firmly on the table. Okay, Section 1, Global Macro Overview, Diplomacy and Data. So, right now, the markets are basically locked in this massive tug-of-war. On one side, you've got this fragile diplomacy trying its best to cap or risk-off sentiment. But on the flip side, central banks are wrestling with inflation that is just incredibly sticky. I mean, U.S. services are showing serious resilience, and input cost pressures are completely persistent. It's like inflation simply hasn't gotten the memo to cool down yet. Looking back at yesterday and last week, oil completely stole the show, while tech, well, kinda sulked in the corner. Those supply risks I mentioned, they kept traders totally on edge, pushing Brent crude to end the week right near $95, which is an 8% jump. Meanwhile, rising bond yields really weighed on global equities, making the Nasdaq the biggest casualty by far. The Dow did manage some modest Friday gains, mostly thanks to semis, defense, and industrials outperforming. As for the dollar index, it basically flatlined near 101.5, and gold just quietly edged higher, doing what it does best, soaking up all that uncertainty. And hey, if volatility decided to take a little coffee break over the weekend, it clearly hasn't looked at this week's economic calendar. Today kicks off with Germany's IFO business climate and U.S. durable goods, giving us a real gauge on economic resilience. But the heavyweight action hits later this week. We're talking US GDP, crucial PCE inflation data ahead of the Fed, massive megacap earnings, testing equity valuations, and rate decisions from the Fed, BoJ, and BoE. It's the whole shebang. Moving on to Section 2, Major Currency Technicals. Let's map out exactly how this macro data builds into actionable setups. First up, we've got the US dollar index. A solid beat in US services PMIs totally offset a drag in manufacturing, which kept the greenback supported. You throw in some renewed tariff threads, keeping things interesting, and the DXY is looking like a very solid buy on dips right now. Keep your eyes on that tough resistance at 101.80 and mark your downside supports at 101.41 and 101.57. Actually, real quick, before we even look at the euro, you have got to see this number, 3.20%. Germany's 10-year Bund yield just hit a 12-year high near 3.20%. That is a massive shift in European debt markets, and it completely sets the stage for how the euro is trading today. And here's the thing, even with surprise 3-month high beats on both manufacturing and services PMIs, the euro still fell against the dollar. That makes Euro-USD a really strict sell-on-rise structure. Now, all eyes are on today's German IFO data for any potential sparks, but tactically speaking, you're looking for selling opportunities near resistance at 1.1388 and 1.1447, with major support sitting down at 1.1310. Moving over to the pound, GBP USD is definitely showing signs of reverting to a sell-on-rise structure. The soft drivers here are super fascinating. UK manufacturing output actually hit a 22-month high, but the currency, it's just suffocating under all this uncertainty surrounding the new Prime Minister's fiscal plan. So look for resistance at 1.3326 and 1.3354 to hold firm, with key support down at 1.3265. Now for USD JPY. Honestly, Japanese authorities are kind of suffering from a boy who cried wolf situation here. The market is flat out ignoring their warnings of bold intervention. Since that jawboning isn't moving the needle, the tactical play here is trading longs with really tight stops. You'd want to buy on a break of support at 162.71, aiming for a target of 164.11, and if it pushes above that, 164.60. All right, Section 3, Indian markets and USD INR. Let's see how global caution is dictating the local action. The Nifty has had a rough ride, extending its losing streak to 5 consecutive sessions. Investors are just totally on edge over U.S. trade tariff concerns and those simmering tensions in West Asia. The benchmark ended at 23,767, with the broader mid-cap and small-cap spaces declining too. In fact, 13 out of 16 sectors fell last week. But the biggest soft point? Heavyweight HDFC Bank, which was a massive drag, plunging 9.40%. Structurally speaking, all that heavy selling pressure makes the Nifty a sell-on-rise market right now. You absolutely must keep your eyes glued to that critical weekly pivot at 23,044. Expect some really stiff resistance around 23,900 if we see rallies, with downside support targets lining up sequentially at 23,576, 23,439, and finally 23,260. Over in the currency space, the rupee managed a pretty nice recovery from its intraday lows that was sparked by suspected RBI intervention and some PSU bank selling. You add in the fact that India's forex reserves just climbed above a massive $676 billion, and the USD INR structure remains a very solid buy on dips. Look to target 96.90 on the upside, with a nice firm floor of support resting at 96.18. So as we wrap up this explainer and head into a massive week of central bank decisions, I want to leave you with this one thought. Between inflation that just refuses to die, diplomatic pauses that could literally unravel overnight, and a calendar completely packed with Tier 1 data, is the market severely underpricing the actual risks ahead this week? Definitely something to chew on. Keep your tactical levels close, manage your risk tightly, and stay sharp out there.